Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. To say they were volatile would be an understatement. Ross tells us where the money is flowing and how gold, crude, and the U.S. and Canadian dollars are doing. Publisher of the realestatetiming.com newsletter, Robert Campbell, tells us debt leverage is the elephant in the room this time of rampant inflation and rising interest rates. He believes gold might be a good inflation hedge. WolfStreet.com publisher Wolf Richter believes this is the most reckless Fed there's ever been and how it's unlikely to fix the economic problems we face or the looming food crisis in Africa. We talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
It's good to be back after a little hiatus there, Jim.
Ross, the stock markets at first after the U.S. Fed hiked rates, they went up, but it seems to be a pretty dramatic reaction afterwards to the downside.
Oh, yeah. I mean, here it was. This was the after the fact news, and, clearly, everybody was hoping for, something that, they could look forward to, what the future had in store, and if it's going to be a half a point rise, then rates, that in theory was going to be acceptable. But, the reality here is that, for all that the economy's got some strength in it and the employment numbers are good, we got inflation problems out there. We got the oil prices still up where they are, et cetera. So, the markets clearly are not ripe, for any decent upside action as of yet. There's some pretty good resistance I have on, and, really things haven't changed a lot in the last couple of months regarding the flow of funds. If we look at, the value stocks versus the growth stocks, this business for the last year, we've seen, the value side increased by about 40 to 45%, versus growth, because growth was just so far beyond reality. And, even in the last 6-7 weeks, we got a 10% move on value versus growth. So it's a market that is overall heavy, has shown very little ability to show resilience in anything other than some very select groups like energy or some of the financial stocks.
Gold, has it held up with the stock markets under pressure?
Yeah, actually, it's held up not badly. Now, we always take a look at things that relate around major news events, and for the precious metals, invariably, when you have these times of extremes and conflict, you will, and such as what we've seen with Russia and Ukraine, you will get that big spike. And invariably, you need to clean out those late investors who just jump on board and during the top end of the conflicts. And so that's what we're seeing right now. We've had a decent clean out. The relative strength index that we looked at got down below 30, which invariably is what you need to see as part of a basing action. And as of now, you're seeing, I think, a reasonable support area as far as the gold is concerned. This we'll call it 1850 to 1880 range. sits with support on the weekly moving averages, and I think it's got the potential to have a decent move. If we can manage to close above 1920, I would say that becomes a catalyst as far as the upside. And typically, if you can start to see some strength in May, June in the gold market, it has the ability to run for a reasonable period of time.
Crude oil prices, are they still on the rise? Have they stabilized?
Well, they kind of surprised me. I thought that we would have a deeper correction than we've seen, and pleasantly here we sit at $110 at the end of the week. This is the best close that we've had in the better part of maybe 4 or 5 weeks. There was good support down in the 95 area. So for us, that would be where we get both the 20-week moving average for support. We've got a sequential 9 on the daily chart, which was down at $95. And market's been just slowly kind of grinding its way up for since the middle of last month. And as long as it continues along here, I think things are reasonably good. The key, the money that's really being made here is not so much in the energy, the oil market itself, but over in the stocks. We're seeing excellent action in all of these Canadian mid and junior oil stocks. They all held very, very well at their 20-week averages, or better than that in this last month and a half. And the bias there, I think, is such that that's clearly one of the sectors you want to be involved with. You can keep it simple by doing either the XLE on the U.S. side or XEG as far as the Canadian market is concerned.
Mm-hmm. Now, on the currency front, the U.S. dollar is doing gangbusters. What about the Canuck buck?
Okay, well, the U.S. dollar, yes. Beautiful base in here. No question about that. And it's shown signs of excess a number of times in this last few months. Each one of those has just had a short pause. And as far as I can see, that at this point, unless, it's stair-stepping up. And so the index is 103.60 as of the end of the week. You got good support back at 102. And, for all that the daily, weekly, and monthlies are all showing some excesses, momentum is still on the upside, and there's no reason to fade that move as far as I can see. Now, the Canadian dollar, and if you take a look at that, and the Australian dollar, if you take a look at the two of them together, they are not only underperforming, but the fact is that they're underperforming relative to, the key commodities. And for the Canadian to be sitting down where it is at this point, around 77.5, is pretty bad when you look at oil sitting at $110. So the bias in both of those currencies, the U.S., the Canadian, and the Australian, I think just look for them to take out the supporting low that we've had for the better part of the last year or so. And it's next key support as far as Canada is concerned is probably somewhere down around the closer to maybe the 72 cent level rather than the 77.5 where we are right now.
Mm. Well, of course, we always compare the Canadian dollar to the U.S. buck because we're the biggest trading partnership in the world and we live next door. But the British pound has really taken it as well. And I only know that because a family member went to Britain 2 months ago. It was $1.72 Canadian. It's now down to $1.59. So the Canadian dollar may be taking it on the chin, but I think they've taken one a little lower.
Yeah. Well, actually, looking at the British pound chart, British pound versus the U.S. dollar here, it's looking at about a 123 right now, and that is on the weekly chart, that's starting to get to a pretty bit extreme. You know, we got the beginning of the well, no, not the beginning of the year, but we'll take it a year ago. We were 144, and here you sit at 123 on the currency. That's a pretty big hit. So, if you're traveling to Britain, maybe it's not a bad time to pick up some British pounds.
Yeah, and some of those cute Union Jack flag souvenirs. Ross?
Yes.
Ross, always great chatting with you.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Robert Campbell next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Robert Campbell. He's the author of Timing the Real Estate Market, and he also publishes the Campbell Real Estate Timing Letter online at realestatetiming.com. He's speaking to us from beautiful San Diego. Bob, welcome back to This Week in Money.
Thank you very much, Jim.
Bob, when does the next Campbell Real Estate Timing Letter come out?
I'm working on it right now, right in the middle of it. It will be out no later than May 15th. And I publish it once every 2 months. And it'll be out May 15th. And these are, as we'll discuss, these are really, really exciting times right now. When things get most exciting for me as an educator, as an analyst that does what I do, and in times of potential major change, that's when fortunes are made or lost, Jim.
Mm-hmm. So in
real estate, you can make big money. In real estate, you can lose big money. So, I mean, my specialty is timing real estate markets, and the prices here in the United States are very elevated. They're tame compared to Canada. I still don't understand your market up there, but that you guys are really, up in the sky. But that our situation here in the United States is for the first time in 10 years, we're right on the verge of turning from a bull market into a bear market. And the downside, the completion of this cycle to the downside is going to surprise a lot of people and cause a lot of pain.
Mm-hmm. Is your book, Timing the Real Estate Market, something people need to read right now?
Yes. If being on the right side of major trends is important to you, if buying low and selling high is important to you in real estate, you should read that book, because that's the golden rule of investing. And especially here, I'm from California, the swings in real estate prices are the greatest in the United States. So it's a perfect time for market timers to buy low and sell high. In fact, one of my subscribers back at the peak of the housing cycle in 2005, 2006 heard me speak. She heard me say, I think California housing prices are going to fall by 43% during the next downturn. I was close. They fell 55%. But she came back years later and told me, she said, Mr. Campbell, I heard that, and we sold our home, which is in a very nice area, for $850,000, and we bought it back 4 years later, after prices had crashed, for $500,000. Same home not the same home, but similar home in the same exact area. So they made $350,000 on that. That $500,000 home, they just sold. They bought that back in 2011. They just sold it last year for $1.5 million. Sold it $1.5 million, and they bought a home, in the eastern part of San Diego County, away from the beach, for $600,000 cash. So she called to tell me. She said, Mr. Campbell, she says, I can't thank you enough. And she's a husband and wife with 2 kids. So and she said, we own a nice home, free and clear, in a good area, and we have $1 million in the bank, all because of you. And I said, it's because, and aside from me, it's because she was smart enough to take action when the major trends were turning as far as when to sell and when to buy. So, let's see, 15 years later, she owns her home free and clear and has $1 million in the bank. That's better than the average guy. So it can be done, everybody.
Is the elephant in the room debt leverage?
Yes, it is. That I was just looking at some stats last night in anticipation of this interview, and I looked back to the inflationary 70s. Inflationary 70s, when Volcker had to raise interest rates, to 20% to stop double-digit inflation. The U.S. national debt was below $1 trillion. That was back in 1980 when he had to raise interest rates. Fast forward 42 years, the American debt, national debt, is $30 trillion. In other words, it's 30 times greater today than it was back 42 years ago when the Fed had to step in to fight inflation and raise interest rates to 20% to stop it. It's that kind of leverage, that additional leverage in the system is what's going to really, really kill people. Because all of a sudden, back then, you could raise interest rates and, okay, yeah, we're paying, triple on debt servicing, which, relative speaking, that isn't a lot. Now, all of a sudden, if they just raise, inflation is at least 8%. So if the Fed were to try to stop inflation, they got to raise rates above 10%. This isn't a magic, it's pure mathematics. That's the way the world works. So all of a sudden, if they had to raise interest rates to let's say 10%, debt servicing in the United States would increase by something like $1.2 trillion a year. We're already running $2,000 and $3,000 trillion deficits, so add another 1.2 on it to that. So not only that, but the leverage in the system is going to kill everybody, especially like the stock market, the real estate market. If mortgages go from 3% to 10%, housing prices are going to go down at least 50%. At least 50%. So that's what we're looking at. And that's the situation right now we're in, that we don't know whether the Fed is going to be brave enough to raise interest rates to fight inflation, or they're just going to let inflation roar and save the markets. So it's a situation, either kill inflation or kill the markets. And I think they're going to take the path of least resistance, because the people that have the biggest money in the markets are, of course, rich people, and the rich people don't want their net worth to fall by 50%. So I think they're going to be real tame is what they do, and I think inflation is going to be a real problem for a long time.
Yeah, the Fed raising the bank rate by 0.5 point this week, the first time they've done that in over 20 years. So they have any options going forward?
No, not if they want to fight inflation. They have to raise it. Historically, you have to raise interest rates, like the Fed funds rate, well above the rate of inflation to tame it down. Inflation's at 8. Let's just be conservative and call it 8. Fed funds should be 10% right now. And what is it, like 0.75 or something? 0.10? They are so far behind the curve. And the day that he made that announcement, he's raising it 50 basis points, the U.S. stock market rose like 938 points or something in one day. Big rally. The next day could be, because what the Fed said, it goes like a 75 basis point is off the table. We won't do it. So the markets interpreted that saying, wow, he's already caving. So the market went up 1,000 points. The next day, all of a sudden, reality set in, and the stock market fell like 1,100 points. And it's been down ever since. So what the Fed decides to do is really important here. Are we just gonna take our medicine and fight inflation and let the chips fall where they may? Or are we gonna try to artificially prop everything up via inflation for the next 5 years where the little guy just gets creamed?
If the Fed takes its foot off the interest rate accelerator, could the bond market force it back on?
Absolutely. Absolutely. Because right now, the bonds are already in a bear market. I don't know how much they're off. 20%. U.S. bonds are off 20%. Because regardless of what the Fed says, inflation is going off at 8, and a 30-year government bond, it pays, 3.0%. Is that a good deal? No. You're losing you're losing 5% per year in the purchasing power of your money every year you hold the bond. That's a crappy deal. So that's why they're trading off. Pretty soon, for somebody to get rid of their bonds, those bonds in the free market, which it isn't a free market, of course, but in a free market, those bonds might have to trade down to a 8 or 10% yield before anybody with a brain would buy them. So for that to be the case, what the Fed's option is, they just keep buying all the debt. The U.S. government puts out a 30-year bond at 3.0%. Everybody goes, no way, I don't want that thing. It's a sure loser. So the only entity left to buy it is the Federal Reserve Board, and they'll keep buying it. And that's where the balance sheet keeps really going up and up and up. And so it's a totally inflated, artificial market. But that means with government bonds, but other kind of interest rates, mortgages, they don't have to stay at 4% or 5%, or credit cards, none of that. So, they can try to keep a lid on this, and to a certain degree they can, but it's going to be at the expense of inflation. Inflation is going to go off like crazy, because every one of those bonds that the Fed buys, 3% government bonds for 30 years, every one of those bond offerings that the Fed buys is the Fed injecting newly printed currency or credit into the market, which is inflationary. Is there any production associated with that? None. Zero. It's just pure cash and credit being injected into the economy, and that's super inflationary. So now you never stop inflation. So where's inflation going to stop? Good question. It's going to stop when the Fed stops it. When the Fed stops printing money. When the U.S. government stops running a 2 to 3 and maybe even $4 trillion deficit every year that is financed by printed money. That's not taxpayer money. They're not taxing us. If they had to raise taxes to cover that deficit, there'd be a revolution. So they just print it up. And that's the situation we're in.
What do you think the real rate of inflation is?
Well, it's well above 8. I would probably imagine it's anywhere in the at least 10 and probably 12 and maybe even 15. Because I know what the individual components are. Housing, hell, housing's appreciating at record annual rates. Here in the United States, we had U.S. homes appreciated by 20.9% in March. If that's not inflation, what is? Rents are going up double digit. Everything's going up double digit. My wife edits my real estate timing letter, and last issue I was talking about inflation. And the government reported that they said, yes, food inflation is up 8.5% last year. My wife was reading that. She goes, that's total BS. She's Sicilian. She shops every day at Ralph's or every other day. She shops every day. She goes, it's at least double that, maybe triple. I mean, talk to somebody that shops every day. It's not 8.5. It's at least double. So you really don't know. But I've seen some reports where it's over 20.
Well, the same bunch of grapes I bought a year ago, we were looking at our grocery bills. It cost $3.30, cost me $11.95.
Yeah, is that 8.5%?
I wouldn't think so. Bob,
exactly.
where should interest rates be?
Well, historically, let's talk about mortgage rates, because my field of dreams is the real estate market. Historically, mortgage rates have always traded 3 percentage points above the rate of inflation. And for good reason. Nobody's going to lend you money for 30 years. That's a guaranteed loser. 3 percentage points. So let's just peg the rate of inflation, even though we probably know it's low, at 3%. Mortgage rates should be 11% right now. And they're 5.5%. So they should be double what they are right now. And the market's already showing, strains that the rivets are starting to give out in the hull at 5.5%. Because in the last 2 years, interest rates have gone from 3.25% to 5.5%. And home prices have appreciated by 35%. So when you look at, mortgage rates are up over 2 percentage points, houses are up over 35% in those 2 years. The $1,000 mortgage payment 2 years ago would be, for the same house at today's interest rates, would be $1,500. So in other words, the mortgage payments have gone up 50% in the last 2 years. That's huge. They've never gone up that fast. So that's slowly starting to have an impact on the market. Home sales are down year over year a little bit. But we're in the 8th inning, ready to go into the 9th inning on this thing. We're close to a peak.
Rising interest rates versus letting inflation continue to grow, are there pros and cons for each?
No, there's no, the only pro would possibly be that you're going to save the real estate market. You're certainly not going to save the stock market by letting inflation go. During the 1970s in the United States, inflation averaged 9% per year for those 10 years. Real estate appreciated 9% for those 10 years. So it was a push. You didn't lose anything, but you didn't make anything. Yet in the stock market, on the other hand, it lost 50% of its real value, Jim, during the 1970s. U.S. stock market, Dow Jones Industrial Average. 50%. So during that 10-year period, in real terms. So there are definitely risks out there, and bondholders got creamed. So there's some real risks out there right now. And while we're talking about, investments, what to own, if you want to build a portfolio that's going to outperform during inflationary times like we have right now, you have to build it around commodities and gold, everybody. Go back and study what happened to those two asset classes during the 70s in the United States. They both did extremely well. And just to let you know that I eat my own cooking, my Roth IRA is 100% in commodities right now. And they're really doing well. And I think they're going to continue to do well. So that's where your money has to be right now. If you really want protection against inflation, commodities and gold. Not real estate, not bonds, not stocks, commodities and gold. Those outperform during inflationary times.
What does all of this mean for real estate?
Well, it means that if rates keep going up like they are, that, pretty soon it's going to cost, your mortgage payment is going to be double, today what it was from, 2 or 3 years ago. People can't afford that. People can't afford that. I mean, incomes aren't keeping up with that kind of price appreciation. And so affordability in the United States, which I'm talking about right now, which is a real key indicator to watch, it's almost, unaffordability in homes in the United States is only like 1 to 2% above what the unaffordability rate was during the peak of the 2006 bubble. So we're right there, guys. We may still have a little farther to go on this because affordability doesn't call turns as accurately as the other 5 indicators that I explained in my book, Timing the Real Estate Market. But it's still it's a good indicator to follow because as long as housing affordability keeps falling, housing prices are likely to keep rising. I know that's kind of like contradicts each other, but that's the way it works. Because people will keep bidding the prices up to a high point, until pretty soon people can't afford it anymore. Their mortgage payments double what it was 3 years ago. Who can afford that? Nobody. So then the trend turns. Now there's no more buyers. All of a sudden, the buyers leave. Home sales start falling. And when demand falls, prices fall. And everybody goes, holy crap, we're gonna lose our butt on this thing unless we get out. And now you got the self-fulfilling vicious cycle on the way down. The whole mood of the market changes from one of optimism to one of pessimism. And now we're in a down cycle. And here in the United States, most down cycles last, about 6 years. So even if we start turning down right now in 2022, I estimate the bottom is going to be somewhere in the range of 2028, 2029. And that's just not a number I pulled out of the sky. Just go back and examine cycles, real estate cycles in the United States, in California, going back to the mid-1970s. Adjust them for inflation, and the cycles will jump out at you like you wouldn't believe. It's a roller coaster ride that never ends, guys. So there you are, and now we're up here at the top at peak prices, near peak prices, and the downside is going to be a bad one. It could be as bad as the last downturn from '06 to '012, where here in California the median price home fell 55%. That's a big. It fell 55%. So okay, in California they go, oh yeah, but prices come back. Yeah, you're right. You know how long it took? You know how long it took prices to get back? Like 14 years. So it was a 14-year trip to nowhere owning real estate to get back to where you were 14 years earlier, adjusted for inflation. That's not being a successful investor. That's being an idiot. So you gotta adjust, everybody. Adjust. And I know it's not easy, but if you want to outperform in this world, you have to do that.
What are home buyers doing and what are home sellers doing after the interest rate hike?
Well, the buyers are still coming in. I mean, but it's fallen a little. Home sales are coming down a little. They're down, I think, in California, 4% year over year, and in the United States down 5% year over year. So in other words, it's starting to have an impact, as I mentioned earlier. Some of those sales, what's interesting is some of those sales that are on the book, that they're showing in March, those sales started not in March, not in February, but probably January, when mortgage rates were 1.5% lower than they are right now. So as soon as these higher rates start manifesting themselves in these current mortgage payments, now you're gonna really see the test. What are buyers going to do? Are they going to step up to the plate? I mean, buyers right now are spending something like, 30% of their disposable income on a mortgage payment. That's right up there with the peak of the market back in 2006. So at some point, affordability kicks in. You know why? Because the lender just won't give you the loan anymore. You go to get a mortgage, you go, yeah, I want to buy this $1 million home. They go, okay. How much down payment you have? I have 10%. I have 5%, whatever. Most people don't have any money. I have 10%. I have $100,000. Okay, you want to borrow $900,000, correct? Okay, good. Okay, today's mortgage rate is 5.5%. Here's your income. Your payment is going to be X amount of dollars, or 50% of what you take home. We won't make you that loan, sir. That's too risky for us. We have a long history of knowing that who keeps making their payments. We're not going to make that loan. So what's my choice, Mr. Banker? Well, why don't you come in with another $200,000 or $300,000 down, get that mortgage from $900,000 down to $600,000 at this 5.5% interest rate, and we'll approve the loan. Nobody has that kind of money. In other words, so the market stalls out right there. No more buyers. Buyers are gone. Buy, and the market starts heading south. Because existing home sales is the purest measure of demand in the marketplace, and it's the buyers who set the market, not the sellers. As soon as they can't get a loan, they're not interested. As long as somebody's willing to lend them money, regardless of the price, they'll go forward. But affordability eventually kicks in, where the banks go, no. We're not going to let you spend 50% of your disposable income on a mortgage payment. We know that's not sustainable. You can't live doing that. You still have to eat and things like that. And what people don't realize is, I don't care if you make a lot of money. All of a sudden, you make $250,000 a year in California after taxes. You're probably walking home with about $150,000, and that $150,000 is what you have to make in California. The average mortgage payment right now on the median priced home in California is at current interest rates is about $8,000 a month. I don't know if that includes tax or not. So in other words, you're making $150,000 a year net, and your P&I payment is $8,000 a month. Multiply that times 12. That's $96,000 a year. You're going to be spending 2/3 of your after-tax income on a mortgage payment? Sorry, Mr. Borrower. You need to come up with more cash, and then the cycle turns.
Is California real estate in a bubble right now?
Absolutely. The U.S. is in a bubble. The whole thing's a bubble, and it's all been driven by the reckless policies of the Federal Reserve Board, printing money like crazy, sending it out, put it into the economy. So it's absolutely a bubble. And, you got to be careful what you call a bubble, of course. But I mean, is it extremely overpriced? Yes. Is it likely to stay extremely overpriced? I don't think so. So it's going to head down, and it's going to head down because people can't afford a mortgage anymore. You know, the median price home in California is $850,000 right now. That's in California, $850,000. In San Francisco, it's $2 million for the median price home. In San Jose, Sunnyvale, it's $1.9 million. Here in San Diego, what is it? It's I don't know, $950,000. That's ridiculous. It's ridiculous. Everybody I know is a millionaire. Everybody I know owns a home. Everybody's a millionaire. But it's all fake. It's all fake. So it's going to come, and it's going to come down. The market's going to revert back to its long-term mean, which that means housing prices are going to fall, you know, nationally maybe 30, 35%. In California, 40, 45, 50. Who knows? Who knows? Who knows what's going to happen? I mean, we have a war in Ukraine. I mean, who knows if this is going to turn into World War III and we're going to start using nukes? You think that's going to change things? A lot of things right now. And the reason all this stuff is going on, everybody, is all these countries are trying to distract our attention from the fact that their monetary policies and economic policies, especially in Europe, have been so misguided for the last 10 or 20 years, there's no way out. There's no way out. That, you know, they've kept interest rates at or near zero in Europe. And now they got raging inflation over there, just like in the United States. And interest rates are zero. Who the hell's going to lend money at zero when inflation's going off at 8%? Nobody. So what's the central bank of Europe is going to buy up all the debt and print money to cover it? That's like dumping gasoline on a raging inflation fire. I know this is kind of like a Jack Clancy movie, Jim.
Looking back at previous housing bubbles, are there lessons to be learned?
Yeah, the lesson to be learned is that that markets go up and markets go down. Bubbles don't last. Everything is fluctuating. Like you know, California real estate especially, which is the most volatile in the country, is a roller coaster ride that never ends. Never ends. And here's the lessons that learn. People that buy at the top get creamed. Get creamed! All of a sudden you buy at the top, and all of a sudden it takes you 14 years later to get your money back. You're the worst investor in the whole world. So you have to be a contrarian to do well in the markets. You have to be a contrarian. But you need a system that helps you determine the best times to buy and sell. And that's what I presented in my book, Timing the Real Estate Market. It was written 21 years ago, and the ideas and techniques I shared with you 21 years ago work as well today as they did 21 years ago. Exactly. So in fact, that book is a classic. But also, what I've learned in the last 21 years is double or triple what I knew when I first wrote that book. So I'm going to write another book. I'm going to share with everybody, in addition to the first book, which is the foundation, here's what else I've learned. So to keep your ear to the ground and your eyes open, you can be alert to major trend changes in the real estate market just by following some key indicators, 5 to 10 key indicators, and you will be 99% ahead of the curve of most people. Guaranteed. Because most people are way behind the curve.
Boomers are in or heading into their retirement years, and for a number of them, most of their wealth is in one asset, their home. We hear some people have taken out home equity lines of credit against their homes to buy stuff. Is this a big concern?
No, because, that interestingly, that people learned their lesson from the 2006 to 2012 bust. That the volume of mortgage equity withdrawals during that period of time is almost 3 to 4 times as great as it is right now. So, relative to what it was in the past, people aren't going to make that same mistake again. They're going to make some other mistake.
Bob, what is jingle mail, and are we likely to hear more about it going forward?
Yes, because people that are buying a home right now, let's say in California, they're buying a home for $850,000, and they're putting 10% down, and they're getting a mortgage loan for $750,000. Now all of a sudden, housing prices 2, 3, 4 years down the road are not $850,000; they're $650,000 or $550,000. So now their mortgage is $750. Their home is worth $750. They're $200,000 underwater on their home. In other words, they owe $200,000 more than they could sell their house for. So jingle mail was that those owners throw in the towel and theoretically, hypothetically, send their door keys into the lender and say, goodbye, we're not making any more payments. And interestingly, the number one reason that people walk away from their house, it's not that they don't have a job and can't afford it. It's the fact that they're underwater on the mortgage. Underwater on the mortgage, that's the number one reason. So that they, put their keys in an envelope and send it to their banker with a good luck message on it. But it's yours. I'm not making any more payments. But it's being underwater. And all these people that are leveraged to the gill right now, putting up, 10% to buy a $850,000 loan, they're going to be so underwater before this thing's over. And a large percentage of them are going to send the keys to the bank and walk away, which puts even more downward pressure on prices. Now the bank's loaded up with this crap that people didn't want to make payments on. So now there's more supply hitting the market. In addition to scared sellers that are trying to get out and save what they've got, by themselves. So it's a cycle that feeds on itself on the downside, just like a cycle feeds on itself on the upside.
What do you see ahead for the stock markets?
I've invested in the stock market for 50 years. I'm much more comfortable with real estate. I think the stock market's going down because I think high inflation is here to stay. And looking back at the 70s, I know how the stock market performs during periods of high inflation very poorly. So my guess would be that the stock market's going to go down, gold's going up, and commodities are going up. So get out of stocks, go to gold, go to commodities.
Your thoughts on gold, silver, and commodities?
Well, I think, we've already talked about commodities. I think that, we're in the early stages of a big run in commodities. And gold, I think that gold is going to turn out to be the premier wealth asset in the next 5 years. And the sky's the limit how high it could go. It wouldn't surprise me if it went to $25,000 an ounce. Wouldn't surprise me one bit. Because I've studied it. And the reason it could get that high is that to protect the bond market that nobody wants to buy, especially because of currency devaluation, countries may have to back their sovereign debt with some gold. 30%, 20%, whatever it takes, so that people don't cash in their bonds, and at a record pace and crash the market. Because if everybody wants to sell their bonds, their U.S. government bonds, the interest rate isn't going to be 3%. It's probably going to be 23%. That's the new going rate, because everybody's rushing to get out of them, so there's all sellers, no buyers. And so the only way that you could stop that is to have some form of backing behind the paper currency. And the easiest is gold. That'll solve the problem. I mean, it won't solve the inflation problem, but at least it'll cause keep the bond market from crashing. And if the U.S. bond market crashes, it's all over.
Are there bullish and bearish case scenarios for the U.S. dollar going forward?
Yes, there are. And in fact, what's interesting right now is the U.S. dollar's been in a rising trend for quite a while, and gold's going up. It's not going up a lot as much as commodities, but it is going up. And normally those run counter-cyclical to each other. When the dollar goes up, gold goes down. And so now they're walking in lockstep, which isn't historically the case. So, but I don't watch that. I just watch gold. In fact, I don't even market time gold. I've owned it for a long time, and it's the keel in my sailboat, Jim. It's what keeps me, you know what? It's cash. I can convert that gold to cash at any point in time. It's safer than the stock market. It may not perform in the long run as well as the stock market, and you never know. There's always that day. And I think they're going to revalue gold again. That's why I think it's going to be the premier wealth asset. They're going to revalue gold to back the fiat currencies to give people confidence in the system. That's what I think is going to happen.
Are you seeing any signs of a recession approaching?
Oh, absolutely. The recession signals are there already. Anytime the Fed starts starts raising interest rates, I mean, recession signs are there. So, I mean, in fact, the yield curve, the 10-year yield curve inverted a month or so ago. And people go, oh yeah, it's reinverted. You know, it uninverted. Doesn't matter. That's not the way it works. You go back and study those inversions going back, 50 years. It inverts, then it uninverts, and then the recession starts. So, and that's a really good, that's my number one indicator for recessions. Because historically it's been so accurate. So yeah, I think we are heading for a recession. Now, how bad the recession is going to be, anybody's guess. I mean, if the government starts sending out money on a wholesale basis, or maybe this new COVID scare will take over, and everything gets shut down, and so everybody's going to get free money to survive without producing anything, then inflation is going to take off, even worse than it is now. So I think we're really in a tough spot right now. Very, very tough spot, everybody. And it's because of the leverage. It's just not doom and gloom. It's because of the leverage. We owe $30 trillion. And if you raise interest rates just 2% from where they are right now, which still it doesn't even get close to being above the rate of inflation. You're only halfway there. The mortgage servicing in the United States increases by $600 billion. So add another $600 billion to the deficit. If it goes up 4 points, add $1 million too. So pretty soon it gets out of hand, guys. Where everybody looks at this stuff and go, this crap's not worth anything. And you go, duh.
Are the various markets looking reminiscent of the early 80s?
Yeah, they are. They really are. I hadn't thought about it quite like that, but that's true. Because during the early 1980s, Volcker raised interest rates from raised them above 20% to stop inflation. We had a real bad recession in the United States in 1980, and it was followed by another recession 1 year later. So those were real hard times. Real hard times. And back then, the U.S. The national debt was less than $1 trillion. So I think we painted ourselves into a corner. I'm trying to look at it as objectively as I can. It's always the leverage, everybody. It's always about the leverage. If you recall back to I forget when it occurred, but it was a hedge fund called Long-Term Capital Management. They blew up. And it was run by 3 Nobel Prize winners that were as smart as anybody. So they really had a technique down for making big gains in the stock market with very little risk. So when you think you have that kind of advantage, you don't want 2-to-1 leverage. These guys were running 100-to-1 leverage. Idiots. And so when the winds just turned a little bit against them, they were upside down, and the Federal Reserve had to step in and bail them out, because the whole U.S. banking industry, would have come apart like dominoes going down, because they're all connected. That's what leverage does for you, and there's a good book on it, guys, if you're interested in looking at that. It's called When Genius Failed. Yeah, look, and it was all because of the leverage. It had anything to do with those guys, being on drugs or alcohol and weren't paying attention? Absolutely not. They kidded themselves, thinking that, if I can make $1 million this year with no leverage, and I leverage up 100-to-1, I can make $100 million. Why not? Let's do it. And they did it, and just a little hiccup in the market blew them out, where they were upside down, and the Fed had to step in. When Genius Fails. It's a great book.
Are there ways to avoid economic destruction?
Yeah, you have to stay ahead of the trend. And interestingly, Warren Buffett had opened up the 2022 Berkshire Hathaway shareholder meeting to the public, and cameras were there. And this is really interesting. I want to get this right for you. A young girl in the crowd asked Mr. Buffett, if you had to pick one stock to bet on, sir, which one would you choose? And here was Warren Buffett's answer. The best thing you can do to stay ahead of the curve and protect yourself is to be exceptionally good at something. Your abilities cannot be taken away from you, inflated away from you. The best investment by far in anything is to develop yourself. It's not taxed. And then applause came in. That's what I would do. And there it is, guys. Be really good at what you do. I tell these kids nowadays, look, I don't care what you do. If you want to be a plumber, you be really, really good at it. Be the best. And you will always have a job. You will never, ever be out of a job. So you always have a steady stream of income. And that's your first line of defense. The markets could go to hell. You know, you get divorced for your wife that was giving you, you know, that was basically supporting the family or vice versa. But be really, really good at what you do. That's not only the best inflation hedge, but that's the best insurance against disaster.
How do the rich get rich?
They buy assets. Plain and simple, they buy assets. Because if you look at the difference between, you know, the top 10%, or let's say the rich, the 1 to 5%, and how they, and why are they so different than everybody else? They own stocks and they own real estate. And because of reckless Fed policies for the last 20 or 30 years, real estate's way up and stocks are way up. So these guys are not rich, they're super rich. But it was the vast majority of their net worth, if not all, came from owning assets. Owning assets. They're not like Steve Jobs, who created these wonderful devices, invented them, and sold a product. Yeah, that was the old honest way to make a living. Actually produce something. Nope, this new way is just, you know, all of a sudden you make a lot of money and you just put it in the stock market and it goes up 10% a year like clockwork, you know, for the next 30 years. And pretty soon, you know, your $1 million stake is now worth $30 million or whatever, you know, 30 years later or more. They didn't do anything. They were smart enough just to buy assets. But all of a sudden, if the whole asset market collapsed, would these guys be able to protect their net worth or be able to survive? Probably not. I'll put my money on the plumber. That's the best plumber in North America.
Who stays ahead of inflation?
The people who stay ahead of inflation are people that own assets that stay ahead of inflation. Either that, and that is, you know, that stocks or bonds, you know, over a long period of time. But other than that, very few people stay ahead of inflation. I remember reading a story long ago where, you know, a guy was a trader on the Chicago Board of Trade. I think he traded bonds, made a fortune over the years. He was a well-known person. And he walked away, you know, at a certain point in his life with $50 million when that was a lot of money. And he said, okay. He gave it to 3 different money managers to trade for him, to manage his money. He said, all I want you to do is protect that based on inflation, taxation, and changing market conditions. If you can just preserve the $50,000 worth of purchasing power of that money for the rest of my life, I will be more than satisfied. That's how hard it is to do, guys.
How important is it to hone your investing skills over time?
Oh, it's really important because that's really important too. So not only this, here's how you do well in life, guys. For every dollar you make, save at least 10 or 15%. Don't spend it, and learn how to invest it correctly. Whatever you're comfortable with, whether it's real estate or stocks or baseball cards or gold or whatever the situation is, learn how to make money and avoid losing it. And that you have to have a system of some kind. Because what's interesting is the fact that everybody tells you, oh, you know, here's the brainless solution. Just buy and hold over the long run and you'll do fine. Okay, I agree with that. What they don't tell you is this, that, you know, over the course of time, that, like, especially in the stock market, they said, oh, you know, going back 100 years, there's only been 4 instances where the stock market has fallen 50% or more. Okay. How many times has it fallen 40% or more? Oh, it's more than 4, right. How about 30% or more? Oh, yeah, it's way more than that. How about, you know, and you go down the list. And then you ask them, is it fun losing money in the market? Or do people panic and get out early? Or are they miserable? All of a sudden their portfolio was down 30%, which isn't that big of a decline. Hey, the NASDAQ right now in the United States is almost down 25. People, it scares people. There goes their nest egg. There goes their retirement. They're going to lose everything. So do most people sit still with a smile on their face during market downturns? No, they're scared to death. And all of a sudden, let's say all of a sudden that what they do is this. They, in a market downturn, the economy's bad. They lose their job. Or they get divorced, because their wife divorced them because you lose your job. And over now you've got to sell everything. Everything is, to divide things up. Everything is sold at a depressed price, not at a high price. So it's hard, but most people just won't sit there. It's human nature, everybody. The amount of pain people feel by losing a dollar is twice as great as the thrill of making a dollar.
Bob, some people have their wealth looked after financial planners so they can sleep well at night. If you had your wealth with a financial planner, would you sleep well at night?
No, I'd be worried to death. Because I know exactly what these guys do. They all do the same thing. It's asset allocation. They try to diversify your assets, so, some in the European market, some in the U.S. market, a lot in bonds, blah, blah, blah. And say that's your best, that's your best solution over the long run, which may be the case. When the stock market takes a 30% dump, a 40% dump, a 50% dump, do you think those diversified funds don't take a huge decline too? Yes, they do. So you're in the same situation. Psychologically, you feel like killing yourself when these things are down. And you say, oh, your account is diversified. It doesn't matter. It doesn't matter. It's like the old expression, that when they raid the bordello, they take the piano player too. Everything goes down in down markets. So, there's no easy solution, guys. I know that's not what the wealth merchants want you to believe. Yeah, you just do this, this, and this. You're going to have a glorious retirement. You're going to be living in Southern California, riding around in an expensive new convertible, just living it up, and and you've probably never been happier in your life. Yeah, that's about 2% of the population. The rest of the 98%, aren't even close to that. So it's the reality of it, guys. And the only way you know that is you're wise enough to get older. Warren Buffett's 91. I just turned 75. With age comes wisdom because you've been through the battles. You've been through the battles. My dad was a builder for 55 years. General contractor, builder. Tough guy. Ex-Marine in the South Pacific. Tough guy. He said, never take advice from anybody under 50 years old. Why is that, Mr. Campbell? Because they haven't had their head in the cement mixer enough times. And it's absolutely true. You realize that this isn't easy, guys. It's not easy. It's always a struggle. But you've got to step up to the plate and meet the struggle and do the best you can. And to win in the long run, the name of the game is adjust, adjust, adjust. Like Charles Darwin said, he who adjusts best over time will be the most successful. Especially all of a sudden you go, wow, I'm underwater. You lose everything. You lose everything. So, that's the nature of it. But you just got to get tough. You got to get smart. You have to have the right attitude. And you always have to be adjusting your portfolio, your job to current market conditions so that you'll be a survivor. The first rule of success, everybody, is to survive. Don't think everybody's going to go out there and make $1 million, right away. No, that's the exception, not the rule. So first you learn how to survive, then you learn how to excel.
Bob, do you have any quick health and fitness tips for us?
Well, let me see. I've given you guys so many over the time. I've got something here. Let's see. What do I want to tell you? Eat more protein. Eat more protein, everybody. That's good. That's really good. I'm doing that. And I'll tell you the biggest difference. I'll tell you one thing. I'm reading a book right now. It's written by a guy called Dave Goggins. Can't Hurt Me. He's an ex-Navy SEAL. If you look on Amazon for it, there's going to be 5,000 reviews, and 88% of it is 5-star. I've only into the first 100 pages of that 350-page book, and it's excellent. And here's the thing, guys. I've known this, but Dave Goggins reinstituted it into my thinking. Motivation is the spark that lights the fire, but discipline is the fuel that keeps the fire going. Anybody can get all jacked up to do something, start a new business, get in shape, learn how to be a better investor, blah, blah, blah. It takes time for all. Now you got to keep doing it. Just keep doing it. Keep learning. Keep getting your body in better shape. Keep honing your skills. That takes discipline, and that's the difference. People say it's all motivation. No, it's not. I can tell you, I've had an annual gym membership for close to 30 years now, and I've seen the cycles. Right after the Christmas, the first of the year, membership shoots up by about 30%. There's a whole new wave of people coming in that are ready to, work out and get in shape. 3 months later, they're all gone. When they're not satisfied with the results. Oh, you mean I can't turn into, I can't get buffed out like I want to in 3 months? No. Especially when you get older. You get to be my age. It's going to take 3 years. Can you do that? Do you want to look better? Yes. Are you willing to commit to 3 years? No. Then you're not going to look better, dude. It's how much you want it. But it's the discipline. That's what determines how much you want, everybody. And what Dave Goggins do to get that discipline, you have to put post-it notes was his technique on your mirror. Here's what I'm going to do. Here's what I'm going to do. And you have to be totally honest with yourself. None of this, gee, I want to get in great shape, or I hate my job, but I don't know what to do. That's your problem. You have to start kicking ass and say, I'm not going to do that job anymore. And you have to have a plan to get away from it and do what you want to do. And that's the motivation. Now the discipline is to do it. It's all about discipline, everybody. People tell me over the years, they said, Mr. Campbell, you know what separates you from everybody else in this gym? I said, no, what? She goes, you show up every day. Even if it's only for 20 minutes. I went to the gym today. Lift weights. You have to keep lifting weights. So it's all about discipline, everybody. And it's a magnificent struggle, life is. Magnificent. You have to have the right attitude. When there's going to be setbacks, don't let them get in your way. You just have to have a kick-ass, killer attitude. No fear. Don't fear anything. And you'll get ahead.
How can people find out more about your book and newsletter?
Okay, they can go to realestatetiming.com. Realestatetiming.com, just like it sounds, everybody. And you can read my book, you can read a sample issue of my timing letter, and you can just learn a little bit more about myself.
Bob, thank you so much for being on This Week in Money.
Thanks, Jim. We'll talk again later. Bye.
My guest has been Robert Campbell, publisher of the realestatetiming.com newsletter. Now we just slide a little further north into California to talk to Wolf Richter in San Francisco next.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to This Week in Money, Wolf.
Thanks for having me back.
Wolf, did the Fed wait too long to raise rates?
Yes. It not only that, but it should have never repressed interest rates this far, and it should have raised them much sooner. Inflation in the United States started picking up in a very worrisome manner early last year, and that became clear to me in the used vehicle market because the psychology changed. And when the psychology changes, that's a real problem for inflation. When suddenly consumers and businesses are willing to pay no matter what. When the normal price resistance just isn't there anymore. That's the inflationary mindset. And once that kicks off, it's really hard to stop. And I've been yelling about it for 15 months. And the Fed has brushed it off, and most of last year, and And so now finally in the fall, they did this infamous pivot and where they started acknowledging inflation when inflation was already raging, and it wasn't temporary and it wasn't transitory, but it was solidly in the economy and spreading across the economy. So the Fed waited at least 15 months too long to raise interest rates. And that's a huge problem now, because now we've got this big raging inflation that we wouldn't have had otherwise probably. And not only that, but the Fed also continued to do QE throughout last year and just tapered and ended it just a couple of months ago. And so it continued to pour fuel on the fire, not only through the near zero interest rates, but also through its bond buying program. It's $120 billion a month that it bought last year every month. And this is this kind of central bank behavior, even while inflation is surging, that just fuels inflation. And it was completely reckless. I mean, I call it the most reckless Fed ever, because there is no Fed in the history of the Fed that repressed interest rates to near zero and printed $120 billion a month, even while inflation was surging. Last time we had this kind of inflation surge was 40 years ago, and interest rates were 8%, 9%, and heading higher. So there is no question that the Fed waited too long, not only in raising interest rates, but also in getting rid of QE and even more so, the Fed should have never done QE in the first place. It printed $4.6 trillion in 2 years. I mean, you cannot get away with this. And the world all over has done a similar thing. So we've got this global inflation, and so when you ask me, has the Fed waited too long? It's really more a question of why did it do all this in the first place? Why all this QE? Why $4.7 trillion in 2 years? And so it's a question of going back to reasonable monetary policies, and this money printing binge has just completely thrown everything out of whack. And now it's going to be very painful and very hard to control all this. I mean, the Fed has to unwind QE, so it has to do quantitative tightening. It has to raise interest rates. We're seeing the markets respond to that. So there's going to be a lot of rough spots out there going forward.
Where do you think the bond market is going?
Well, when interest rates rise, by definition, bond prices fall. And the 10-year yield today is solidly above 3% in the United States, and the 10-year Treasury yield, the 2-year yield is at around 2.7%. The short-term interest rates that the Fed have now been raised to about 1%. So if you have short-term Treasury bills, if you have 3-month or 6-month bills, the prices are not impacted that heavily by changes in yields, and you can hold them easily to maturity. But if you're sitting on a 30-year bond that you bought 2 years ago, when the yield was really low, was below 2%, around 2%, and now you're looking at substantial losses in the price of the bond. So you can hold it to maturity and continue to earn this very low coupon interest rate, and for the next 28 years, or you can sell it at a very large loss. And so this is already the case, and the Fed has just started. So this is just the beginning of the rate hike cycle. The Fed has done the second rate hike. This is the beginning. It's going to hike rates all year. It's going to neutral wherever that is. That may be 2.5%, that may be 3% on the short end, which means that long-term interest rates are going higher. It's unwinding its balance sheet. This puts upward pressure on long-term yields as well. So the bond market is just in a complete, in a world of hurt, and that's predictable. When interest rates go up, that's what happens to bonds. But the bond market has been in a bull market for 40 years, essentially. For 40 years, there were only short periods when yields went up, and then yields went back down and further down than they were before. And based on inflation coming down from the highs in the early 1980s, and this period has ended. So now we're in the bond bear market. We don't know how long it'll last, but the 40-year bond bull market is finished, and going forward, this looks like a very punishing time to be in the bond market, and especially if you have bond market mutual funds. They can be in real trouble if you buy bonds and hold them to maturities, and they're high quality bonds. You have less of a problem. There may not be great investments, and you might not earn what inflation takes out of you, but you'll get your money back when they mature. But with bond mutual funds, that's not the case. And I really don't like bond mutual funds, and many of them have taken a huge licking in price. Those that you can trade and bond mutual funds as well, so ETFs and bond mutual funds. And this has turned out to be a very terrible investment for the last really year and a half.
What is likely to be the psychological effect of soaring inflation and rising rates on the housing markets?
Yeah, this is tough. People have always looked at, not always, but in recent years have looked at a home as an asset that constantly increases in price. And a home should be looked at as an expense. It's something that costs you money. It provides shelter, and it provides pleasure, and it allows you to raise a family, and it has some functionalities, and it should be considered an expense. And when you're ready to accept that, price fluctuations don't really make that much of a difference. But when your home is an investment, a highly leveraged investment, where you may have almost no equity in it. So when home prices starting to go down, that has a fairly significant impact on the psychology of homeowners. And so that's what we're looking at. We are seeing mortgage rates spiking in the United States after prices have surged, so people can't afford to buy those homes anymore at those prices. So a whole layer of buyers is taken out of the market every time mortgage rates go up. And so there's fewer and fewer buyers. The volume is coming down, and we've already started to see some price declines in some markets, but that will take a while. And then when that sets in, that psychology of declining home prices is tough to deal with. And in addition, you have the problem of people got used to refinancing their homes and taking out cash to do that, to buy other things with, and to pay off their credit cards and to spend on vacation. Now cash out refis are essentially fizzling, and regular refis without cash out, but to lower your payment, they have died. And so this whole support of consumer spending through the housing market via these mortgage refis is fading too. So people can no longer spend easily the equity they have in the home, because that equity is starting to decline and interest rates are surging, and so it's very difficult to take that equity out of the house and spend it. And this going forward, this will cause consumers to lose access to this type of funding for the consumer spending. And of course, this was a huge boost to the consumer spending numbers we've had in 2020 and 2021, especially for durable goods, when consumers went just completely haywire, buying all kinds of stuff. And some of that was purchased with funds from the home, that extracted from the home that way, and that all is ending. So the psychological impact of the housing market are pretty significant on consumers and consumer spending.
Does the stock market correction look like it's over for now?
Yeah, Jim, this is a great question. When we last night, we're looking at the market that had jumped. So today is Thursday. So last night was Wednesday. The Fed had announced its rate hikes, and we've had this huge 1.5 hour surge in the stock market at the end of the day yesterday, and with stocks being up 2.5%, 3% for the different indices. So today, stocks are down 4% to 5% across the indices while we're speaking. So on Thursday, this is the reaction. It finally sank in what the Fed is doing, and so the price spike yesterday was completely unwind, plus some today. I don't think that the stock market correction is over. I think it just started. This is the dot-com bust all over again, only worse. It's broader and it's bigger, and it includes more segments. We've got cryptos in there now too, so the damage will be bigger, and I think it will drag out for years. It'll go up and down. There'll be a bear market rallies like we've had yesterday, and some of them may be a little longer than just an hour and a half, and so we have these rallies that rip your face off, and then we have the plunges in the markets afterwards to take us to lower lows. And I think we're far from seeing the bottom in the market. This is going to drag on, and with inflation being high, the Fed can't cut interest rates. So there is no put on the stock market. The Fed put is out the window. It's gone, and investors have to realize that. And higher interest rates mean financial conditionings are tightening for a lot of zombie companies that are traded in the stock market. So some of them will go bankrupt, and shareholders will lose everything they've got in those companies. Many of them already trade down 80-90%. They've gotten beaten to death already in the stock market. This has been going on since February last year. It is not something that just happened. So I think we're looking at a fairly long downturn in the stock market.
Where does the U.S. dollar look like it's headed from here?
Well, it's been strong and against other currencies, and the thing is, the Fed has gotten serious about inflation, and before it did, the dollar got beaten down pretty hard, and then when it started to pivot and acknowledge inflation, it recovered. So it bounced back, and against currencies such as the yen, where the Central Bank of Japan is still imposing negative policy rates, and it stopped QE, but it's far from announcing any kind of quantitative tightening. So the yen has gotten punished, and it's now trading at something like a 20-year low against the dollar. And there's this big, broad trading range that we have in these currency pairs, and so we're bouncing into the limits of these long-term trading ranges, and such as with the yen. The euro too's lost a lot against the dollar. The ECB also has so far not done anything really. They're still doing QE, even though they slowed it. They're going to stop it. They're going to raise rates later this year, but they're really, really far behind the curve. So against these currencies, the dollar has been very strong, and against a lot of other currencies, And I think this will continue as long as the Fed keeps pushing interest rates higher. This makes U.S. investments very attractive to investors from other countries. So if you're looking at negative yields in Euroland, and you're looking what's going on in the United States, and you can hedge against the currency risk, this makes a lot of sense to switch some of those bond investments over to dollars. And I don't see any big change in that. I think the dollar will continue to be fairly strong.
President Biden this week announced $3.1 billion for EV battery manufacturing and $60 million for EV battery recycling in the U.S. Is this likely to fuel growth in electric vehicle production?
Yeah, it could. It's not a lot. They're also rolling out over $50 billion in incentives for the semiconductor industry to build semiconductor plants in the United States, and they're rolling out billions of dollars in incentives for the nuclear power industry. And all of these things have to go through Congress, so we'll see where this goes. But $3 billion in incentives for battery manufacturing in the United States is pretty small fry compared to those numbers. And but EV batteries is a bottleneck for the EV industry. There's a lot of demand for EVs. Nobody can build enough of them right now because of the supply chains, not just batteries, but even normal vehicles, you can't build enough right now because of the semiconductor problems and other supply chain issues. So EVs are not exempt from that. The supply chain issues are all over the place, but long term, so even after the normal supply chain issues get resolved, the EV battery manufacturing issue is still a key technology for EVs. Now, anybody can build an EV, not anybody can build a battery. That's where the technology really is critical, is with the battery, and the United States is not on the leading edge there. When most of the batteries are made in China, and they have some really, really good makers there. And Japan is strong, and Panasonic makes good battery cells, and they're making some of them in the United States. And Tesla uses Panasonic battery cells. And so, if we want to be competitive, we meaning U.S. automakers, if we want to be competitive in the EV market globally, we have to have some control over the battery technology, and U.S. automakers are all trying to figure out how to make better batteries, how to make them cheaper, and to get a handle on this very complex technology, and it's the key technology in EV manufacturing. It's the one thing that everybody wants to control, and so if that $3 billion helps getting something started, that may be a good thing. I don't know that will do much. This is a very complex issue and a lot of technology, a lot of science, a lot of research involved. So we'll see where that goes. In terms of the recycling of the batteries, that's another key technology. That's already happening. But, you have to have enough supply of batteries to make that work. There has been very little supply so far because EVs are fairly new. And so for EVs to produce batteries for the recycling industry, those EVs need to be 7, 8, or 10 years or 20 years old, and we don't have many old EVs like that. So this is something so for the industry to build capacity, we need to have supply, and the supply is just not there yet because you don't have enough old EVs out there that are taking out of circulation. So, or where the batteries are having to be replaced. The numbers are pretty small still, but that's happening, and EV recycling, and the whole auto industry has been recycling just about everything for 100 years. I mean, that's the recycling of auto components and materials is as old as the automobile itself, and I mean that's been a big part of the industry. And for EVs, it's going to be the same thing. They're going to recycle everything they can, and simply because it makes money. It's you get something for free, and then you take it out and you sell it. And that's the whole thing about recycling, whether it's steel or aluminum or different plastics or now the battery cells, the chemicals that are in those. And so I think it will be helpful to have all these in place. EV production right now is handicapped by shortages and by supply chain issues, and that's what's keeping the volume down. But in terms of putting the United States into a leadership position with EVs, I think it's good to push on the battery technology and on the technologies involved in recycling.
Are the rising prices of gasoline and diesel a leading indicator for the economy?
No, I don't think so. The rising prices of gasoline and diesel are an issue for consumers. They gripe about it. It's so immediate. You go to the gas station, and what was $40 a few months ago is now $50, and you see that, and it's a lot of money all at once, and so it has a psychological impact, and everybody takes pictures of the crazy prices we're now seeing at the gas station and posts them online, and I've done that, and everybody's doing that, but it's in your face inflation. But it doesn't really say much about where the economy will be going. If gasoline prices go up high enough, there will be some demand destruction. We've seen a little bit of that, but not a whole lot. In terms of diesel prices, they're being pushed into the prices of products that we're buying. So transportation companies are passing that on, and so businesses and retailers are passing those charges on, and consumers and eventually and other businesses will pay those higher fuel prices because in part of the higher transportation costs. And so this is part of inflation, and it feeds into broader inflation through transportation costs, and it's something what the Fed will have to battle. It's going to have to get that down, and so far the demand destruction from just gasoline price increases has been fairly small. People are prioritizing the more fuel-efficient vehicle. When they have two vehicles sitting in the garage, they're going to take the smaller one to go someplace, and they might drive a little less. They might walk to the store when it's 5 minutes on foot instead of driving, and they might not do a driving vacation but go someplace and stay there. So that's consumer behavior that changes, and we're seeing a little bit of that, but not much. And so far, we haven't seen any drastic moves, and I don't think it means that it's a leading indicator for the direction of the economy. I think it's a big part of inflation, and it's a big part of what the Fed needs to address.
What are you hearing on food shortages?
Well, it's a tragedy in a sense. I spent quite a bit of time in Africa, and there really weren't any food shortages there years ago even. What there was a shortage of affordable food, and people couldn't buy the food. And so you have people starving because they're poor, and they can't buy the stuff that's available. And so if you have enough money, you can buy just anything, And now they're starting again. Food prices are shooting higher, and for wealthy countries, that's not a huge issue. You still can get, you still can afford the food. It hurts, and most people can still buy enough food. They still have enough money to buy enough food, even though there's starting to be some problems with some people not having enough money. And food price increases hit poor people the most, because they spend most of their money on the basic necessities of life, including food. And when that stuff goes up, where do you go? You can't step down far. And so this is an affordability issue rather than shortages. People will have trouble, poor people will have trouble buying what they want to buy in terms of food. It's very challenging, and it's a nasty thing to happen, but it's not like we're going to run out of food, but food's getting expensive, and some people, quite a few people in poor countries, will be struggling to buy enough food for the families, and that's a horrible, tragic thing to see happen during inflationary periods, and we've had food riots, because of that in all kinds of countries. You have these leading to political change and often to dictatorships and other issues and brutal repression. People are rebelling against these high food prices, and at the same time there's enough food, they just can't afford it. And I think this is something that we'll be grappling with, and that is in part why there's now a worldwide crackdown on inflation. We've got to get this inflation under control, because high food prices is a massive human problem, and it's not that we're running out of food, it's that we can't afford the food, and that makes the problem so much worse, because there's this line of wealth in between the people that can eat and the people that can't eat, and that's a tragedy that needs to be addressed through a massive crackdown on inflation.
Now, we've been told that interest rates have to either equal or top the inflation rate, and the official inflation rates in Canada and the U.S. between 6 and 8%. And of course, that's just official. We know unofficially it's higher than that. Does that mean we're going to see interest rates hit 8 or 9 or 10%?
Yeah, so we'll find out. Right now I'm in the school of thought that the Fed has, and the Bank of Canada too, and other central banks, they have a huge balance sheet. So they have billions of dollars, trillions of dollars in the Fed's case, of bonds that they purchased and that they can sell. And that's a weapon that they didn't have before. So if they raise short-term interest rates to, say, 4%, and which is still far below the rate of inflation, and then if they start unloading enough of the bonds, that pushes up long-term interest rates and causes all kinds of havoc in the financial markets. And havoc in the financial markets causes people to be more careful about buying stuff, So the mood turns sour, and exuberant financial markets lead to more consumer spending, and mayhem in the financial markets lead eventually to a reduction in consumer spending, and that then it takes some of the fuel off inflation. And you might see inflation go down because of, in part, short-term interest rates are higher than they were, but not as high as inflation, and in part because there's mayhem in the financial markets, and the housing is going down, bonds are going down, stocks are going down, and people are worried, and they don't spend as much. And instead of buying another $100,000 pickup truck, they might just drive whatever they have for another year or two. And instead of doing the $200,000 home remodel job, they might delay that. And they might not go on vacation because they just lost $1 million in the stock market or in cryptos, and so you see the demand fade a little bit from that corner of the economy, and I think this is the central banks are kind of targeting the financial markets. When you're looking at what they're doing with QT, they're starting to cause some mayhem in people's capital gains, and I think that has a good possibility of putting enough downward pressure on inflation, combined with short-term interest rates in the 4% range maybe, to where the short-term rates don't have to go up to 8 or 9% like they were in the 1980s and double digits in the late 1970s and very early in 1980. And so I don't think we have to go there this time. I think we can have the short-term interest rates be somewhat lower, but much higher than they were there now, and with long-term interest rates rising, and with financial markets being in chaos, and I think inflation has a good chance of fading away that way.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Robert Campbell, and Wolf Richter. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.